welcome back to my YouTube channel in which I share about investing, personal finance, and occasionally some music. So today I'm going to talk about growth investing versus value investing. Not sure if you have heard about those terms, but if you have been in the stock market for a while, then you would have known that there are two types of investors. One that practices growth investing, one that practices value investing, and also there's a category that practices both. So, how to decide whether you should be a growth investor or a value investor, or maybe you want to be both types. Now, let's dive into this topic today. But before I start, do click on the like button to support me and also subscribe to my YouTube channel if you enjoy content like this and you would like to learn more. Investors that practice growth investing look for companies that are expected to outperform the market in terms of revenue growth and or profit growth. So this type of growth companies, they introduce innovative and new goods and services to the market, and with their unique selling proposition, they are able to disrupt existing markets by stealing market share from existing competitors, or even create a new market for their product because perhaps prior to their existence, there is no market for such products that they are offering right now. So for example, most of these companies belong in the technology sector. For example, your Facebook, Amazon, Google, Alibaba, Grab, Uber, these sorts of companies. Now, growth companies, because they're still in expansion mode, a lot of them are still not profitable yet because they're still spending a lot of cash on marketing expenses to acquire new customers, or they're still spending a lot of money on research and development to develop new products. So they're still burning cash and are not profitable for the moment. However, investors may tend to forgive this type of companies because they expect the future earnings to be good. So in terms of valuation, growth companies tend to have high price to earnings ratio because investors expect them to generate high cash flows in the future. Now, for those that are not profitable yet and do not have a price to earnings ratio, investors will compare these type of companies using the price to sales ratio, which is equal to the market price divided by the company's revenue. In terms of income or cash, well, because a lot of these companies are still reinvesting their cash to grow their market share, most of them will not be paying out any dividends to investors. So if you want to invest in growth companies, you will be seeking for capital gains and not so much dividends. In contrast, value investing involves investing in companies that are undervalued, which means their share price is currently lower than their actual fair value. So an undervalued company, it may be undervalued because it receives, say, negative publicity because of some legal issues, or perhaps it suffered a bad earnings season, or perhaps it does not receive sufficient media attention. But actually, these type of companies, their fundamentals are still good. So usually there are companies in well-established and mature industries, like for example, consumer goods industry or banking industry, that sort of companies. Now, Benjamin Graham, often considered as the father of value investing, he looks to invest in companies that are trading at share prices below their liquidation value, whereby liquidation value is equal to the value of the company's assets that a company can sell for to get cash. Now, Warren Buffett, which also practices value investing, he looks to invest in companies that are trading at share prices below their fair value. And generally, these are high quality companies with sustainable competitive advantages that are able to compound returns over time for investors. Now, value companies, they tend to be valued low relatively to growth companies, so they tend to have low price to earnings ratios. And because they do not spend a lot of cash on reinvestment for growth because they're already mature, they will tend to give out any spare cash they have as dividends to investors. In terms of investment styles, whether growth investing or value investing is suitable for you depends on your own investment profile. You need to take into consideration your investment goals, your investment time frame, your risk appetite, and preference for cash. So growth stocks tend to be more volatile. Yes, they can give you higher returns like what we have seen across the past decade. Technology stocks have performed really well, but they also tend to be more volatile. Their price swings tend to be larger in magnitude. So if you're the type that will not be comfortable seeing the stock prices going up and down, fluctuating all the time, then perhaps you want to stay away from growth stocks and instead invest in value stocks, which tend to be more stable. However, if you have a longer investment time frame, then you can still invest in growth stocks and enjoy higher returns across the long term. This is because any short-term fluctuations can be smoothed out over the long run. Now, other than that, because growth stocks do not give much dividends to investors, if you prefer to have cash coming into your pockets, like say every year, then you would want to invest in value stocks, which tend to give out dividends, and some of them do give out pretty generous dividends. Now, other than volatility and your investment time frame, your risk appetite, and your cash needs, you also need to consider the market timing if you are a short to mid-term investor. Whether growth stocks or value stocks perform better actually depends largely on the point in the business cycle that the market is currently in, and also the time that you are putting your investment. So if you look at value stocks, they tend to perform better during recessions or in the early phase of a subsequent recovery, while technology stocks, your growth stocks, tend to perform better in bull markets when the economy is expanding, or they also tend to perform better when interest rates are low, say in the case of an expansionary monetary policy in place. So if you're a short to mid-term investor and you're looking to time the market, whether you choose value stocks or growth stocks will have to depend on the current situation of the economy and how long you intend to invest in that particular stock. If you find it hard to decide, maybe you can choose to have a blend of value stocks and growth stocks in your portfolio. Like you see Warren Buffett, Berkshire Hathaway, his company, it invests in both value companies and also growth companies. So it holds investments in the traditional companies like banks, consumer goods, insurance companies, and it also holds investments in technology companies like Apple, Amazon, Snowflake, etc. So it is a good thing to have a blend of both value stocks and growth stocks in your portfolio if you cannot choose to decide which one is best for you. So how can you start implementing a growth investing or value investing strategy? Well, the easiest way to start is to invest in an index fund or an exchange traded fund known as an ETF. So if you invest in such funds, it will mean that you are employing a passive investing strategy whereby you just invest in a basket of stocks that make up an index that the fund is tracking. So you gain the benefits of diversification and you do not need to monitor each stock individually. So this strategy would involve fees and expenses that are lower than you investing in an actively managed fund. If you would like to understand more about index funds or ETFs, feel free to check out my previous video whereby I explain more in detail on the benefits of investing in index funds or ETFs and also how you can choose the best one for your own investment. Now the video link is in the description section below, so check it out when you have time. Otherwise, you can also employ an active investing strategy whereby you cherry pick the individual stocks that have either a growth criteria or a value criteria. Now to succeed in this strategy, you would need good investment knowledge so that you can pick the good stocks and avoid the growth traps or the value traps. So growth traps would be companies that, they are growing, but they keep burning cash while they are growing and there is no pathway to profitability. While value traps would involve companies that, yeah, they are valued low, but for a good reason. It is because they are no longer attractive. Their fundamentals have deteriorated. So you would not want to just sit there and wait until it can get back on its feet again, because it may never do that. If you would like to invest in exchange-traded funds, then you can check out S&P 500 growth ETFs and value ETFs, or Russell 1000 growth ETFs and value ETFs. Now, the difference between S&P 500 and Russell 1000 is just that S&P 500 index consists of large cap companies in the US, while Russell 1000 index consists of large cap and mid cap companies in the US. So for these two indices, there are ETFs that track value stocks as well as growth stocks. So feel free to check out these different ETFs on the websites of these different fund providers. Now, although these ETFs, they may track the same basket of stocks, but they can have different expense ratios. So this would be one thing you want to take into consideration. So that is all for today's video. I hope you have learned something and maybe it can give you some idea on whether you want to practice growth investing or value investing. So which type of investment style do you prefer? Leave your thoughts in the comments section below. And I will see you in the next video. Oh, before you leave, please don't forget to click on the like button and also turn on the notification bell to get updates on my next video, whereby I will be sharing more about investment strategies or market outlook, that kind of thing. So stay tuned, take care, stay safe, bye bye.